Before we start, I will want you to hit that red subscribe button and also smash the like button. Hey guys, what's up? Welcome back to The Impeccable Investor. Budgeting is a process where an individual calculates his spending expenditures to allocate his monetary resources to increase efficiently. Having such a plan gives you an edge of planning in advance for the things you need or would like to do in the future with the money you have. As monetary supply is limited, one needs to budget carefully to make out the best from what he has. This article would describe a budgeting rule used by many known as 50-30-20 budget rule. If one doesn't have enough money to do everything he or she likes, then this is the best planning process to go for helping an individual achieve maximum efficiency. Let's talk about the 50-30-20 rule. Step 1 of the 50-30-20 rule. After the deduction of all legal penalties such as direct taxes, local taxes, and state taxes, one is left with a disposable income. Being an employee with a steady paycheck, this rule turns easier as there is comparatively less calculation required. But if you have a business of your own, meaning that you are self-employed, one has to subtract his business expenses from his after-tax income. This would give you the amount of the disposable income you have to spend. Step 2. Limiting your needs in the 50% boundary of your disposable income. The first thing you do for step 2 is to calculate the amount you spend on your needs. Needs include all the necessities which are important, things like groceries, healthcare expenditure, etc. The 50-30-20 rule makes you restrict your rules to a boundary which can't exceed 50% of your after-tax income. To do this, one has to separate his needs from wants, categorize them carefully so he doesn't miss out on essentials. Any object that could be left without making a mark to you convenience should be added into the want list. It can range from anything like your daily expenditure to your mobile bills and etc. If one cannot forego a payment such as minimum balance to open a bank account, a fixed cost to pay for letting his business run even if it's not making a profit, then that cost is considered a need. Step 3. Limiting your want to 30% of your disposable income. Now one needs to categorize his wants too. There could be different things that one could consider as a want, which could range from having an ice cream daily to having a luxurious sports car. The thing is that one can categorize what he can have and what makes him happier within the 30% range of his disposable income. Spending a hefty 30% on your wants might sound good too, as one has room to fulfill his wants like a cool haircut, a small trip to somewhere, food at his favorite restaurant, and much more with this 30%. Note, categorizing a want could be very tricky. For example, buying the same clothes from a mall rather than a local outlet counts as a want. This might be difficult to categorize, but once everything is sorted out, it would get easier. Step 4. Spending the remaining 20% on your debts and for savings. Out of your disposable income, one should save at least 20% of his after-tax income. The reason is very simple, as there could be times when one could land himself into an emergency or times when one needs some extra cash to fulfill a want or need. This is where the saving comes in for the rescue. These 20% could also account for debt payment. For example, if someone is buying a house on installments and the installment per month is $1,000, if one pays $1,500 a month with $500 as an additional amount, this counts up into this 20% of debt payment. This makes his installments ease out in the distant future, helping him spend his next 20% of saving somewhere else. An example of the 50-30-20 rule. For example, there's a man who is employed by XYZ company and gets paid a $5,000 monthly salary. After deduction of all the direct taxes and whatever taxes he is obliged to pay, he is left with a $4,500 disposable income. According to the 50-30-20 rule, this man needs to restrict his needs below the 50% ratio, which in this case comes at a price range of $2,250. He should not exceed this ratio to follow the plan. Next in line comes the 30%, which he is allowed to spend on wants. According to the plan, he could spend $1,350 on his wants. This means a $1,500 iPhone is out of his wants list. Last but not least, 20% saving or debt payment rule applies. The 20% on his income calculates to be around $900. This means that the guy could save, invest, or work out any of his debt with a $900 amount which he has. He could also spend it on his wants in the coming months or on his needs, which would make spending easier for him in the coming months. He could also be using it up in times of emergency. This is how the 50-30-20 rule works to create an allocative, efficient budget plan. This brings us to the end of our video. I hope you enjoyed it. Hit like if you did, and don't forget to subscribe to our channel so that you don't miss any of our videos in the future. Also watch the 2 videos that are on your screen because I'm sure you'll love them. With that, I'll see you in the next video.